Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending September 20th, wrapping up the third quarter. Let's go ahead and dive into the charts and take a look at what we're seeing. Starting out with the cryptocurrencies, taking a look at the Bitcoin chart here. Still seeing some sideways price action in the Bitcoin price action. We're chopping around in between around 18,400 and about 20,500. We've been talking about kind of watching that range for a while, for the last week or two, and expecting a breakdown to the downside at some point, but we're looking for a close below that 18,400 level before we'll likely re-enter a short position, and then likely looking for Bitcoin to drop down. Once we get past this anchored VWAP around 18,000, then we'd likely be looking at a target of about 14,000 on Bitcoin. And then jumping over to the Ethereum chart, you can see where we're at with that one. We're holding up a little bit better on Ethereum, but we also have some sideways price action on this one. Looks like we're chopping around between 1,400 and 1,225. Also looking for a downside target once we do break that sideways price action. Looks like we got some pretty good volume support right around the 1,000 to 1,100 range. But if we do see a breakdown below those levels, we could get back down to this anchored VWAP position, which is currently sitting at about 875 on Ethereum. And let's go ahead and jump over to the traditional markets with the S&P 500. These two charts here we're taking a look at represent the percentage of stocks within the S&P 500 that are above the 200-day moving average on this top panel here, and the bottom panel are the percentage of stocks in the S&P 500 above their 50-day moving average. And we are sitting at 12.2% of the stocks above their 200-day moving average, and only 3.2% of the stocks above the 50-day moving average. So definitely very bearish signals there. Not a lot of stocks are sitting above either their 200 or their 50-day. So definitely some caution there in the markets. Let's jump over to the S&P 500 chart, the SPY. Taking a look at this one, where we're likely heading from here. We can see over here back in February of 2020, before the COVID crash, we had peaked out on the SPY chart right around 340, 339, and looking for that as our next downside price target. We do have some anchored VWAP support sitting right around the 353, 354 level that we'll likely have to contend with, and we may see some short-term support there. But once we get below those levels, we'll be looking for that downside target of that previous highs before the COVID crash, which is sitting at about 339. I think we'll probably get there fairly quickly. The markets are looking pretty bearish right now, as we're going to see through quite a few of the charts that we're going to go through. But once we get down below those levels, I could see us getting even further to the downside, looking for some possible downside price targets from there, right around 320 or 326 on the SPY. Then jumping over to the NASDAQ, our triple Q charts, we are above our previous COVID crash highs on the triple Qs. Those were at about 237.70, and that'll be our next kind of downside price target on the NASDAQ. We did break down below the June lows on Friday, which was sitting at about 270, and we did have a close below those. So we're definitely looking for downside price movement on the NASDAQ, and that 237.70 looks like the next logical support level. We may see a little bit of support potentially sitting around the 250 level, but I think that'll be fairly short-lived, and then likely looking at that 237.70 for the next downside price target, and we could definitely go lower from there as well. And then jumping over our Dow Jones Industrial Averages, we are actually below the previous COVID high, the highs before the COVID crash. On the DIA, we were sitting at about 296 before the COVID crash occurred, and we are actually sitting at 287 now on the Dow Jones Industrial Averages. So we are actually already below those levels, and I think we are definitely heading lower on this one as well. Our next support level that we'll be looking for is about 274 on the DIA, and then likely heading lower from there. We've got an anchored VWAP support level sitting at about 253.95 currently, which is also at a trendline support at about 254. So that looks like that could be maybe a really strong support level right around those ranges, but we have a couple others to contend with before we get down to those levels. That first one being at about 274, the next one at 267, and then likely looking at that 254 level on the DIA. And then jumping over to Dow Jones Transportation Index, we can see that we closed 2 weeks ago below the 200-week moving average. We tried to rally up above that this last week, but that rally failed, and now we did close lower on the week from the previous, and looks like we are heading lower from here as well on the transports. We've got some support at about 11,400 that we'll be watching. But the way things have been going in the market, seems like that'd be a pretty good bet that they'll likely fall down lower from there. So our next support level, if we see a break below that 11,400, we'd probably be looking at somewhere around the 9,700 level on our transports. And then taking a look at our Russell 3000 chart. We've been talking about this one for quite some time. This up channel trend lines have been in place since the great financial crisis, so well over a decade of price action here. We've only broken out of this channel one time, which was the COVID crash, where we actually broke down to the downside on it. It's looking like we have a good chance of potentially breaking through that as well this time around. But first we've got to contend with that bottom channel line, as we've now broken down below the 200-week moving average, and there's not a lot of resistance there until we get back down to those levels. So that could be anywhere between about 1885 to maybe as high as about 1950 or so. It just depends on how long it takes to get down to this bottom channel. We'll probably see some level of support at those levels, but it wouldn't be super surprising to actually see it break down below these levels, as well, as things are looking pretty bearish out there. And then jumping over to Russell 1000, our large cap index, also broke below the 200-week moving average this week, so that's also a pretty bearish indicator there. Be looking for that next support level, which on large caps, which is the previous highs before the COVID crash at about 188.95, and if we do break down below those levels, our next support level on that one would be about 164 on the IWB. And then taking a look at our Russell 2000, our small caps, those are sitting at the June lows still, so they haven't actually broken down below those June lows quite yet, but they definitely look poised to do so. We also have some anchor VWAP support at about 161. Once we do break down below those levels, we'll be looking for support at about 144, and also 130 is the next couple downside targets on our Russell 2000 chart. And then taking a look at our growth versus value, we did see growth start to outperform value for a period of time, and we started to see value actually start to outperform growth, and then we are now looking like things are maybe heading back towards the value side of things, but either way, both value and growth are pretty much bearish on all sectors and all areas right now. Diving over to our sector chart here, all the sectors that we track over the last trading week, we can see at the top here that we only had two sectors that were in the green on the week, and that was cloud computing and biotech, both up about 0.5%. The next best performing sectors that were down just about 1% was gold, healthcare, and home builders. And then scrolling down to the bottom, taking a look at the worst performers, we can see clean energy at the bottom with about 8% drawdown, so utilities with almost 8% drawdown, solar with about 7.5% drawdown. Also, some of the worst performing sectors, we've got EV and self-driving, global lithium, real estate, global auto index fund, so quite a few sectors that are down 5, 6, and 7%. And then taking a look at our oil chart, we're looking at U.S. barrel prices. We are currently sitting at about just below $80 per barrel. We did get down to the 76.55 support level, and we're actually looking for a potential breakdown below those levels, potentially to our 200-week moving average, which is currently sitting at about $63 a barrel. Still think there's a good chance that we get down to those levels, but 76.55 has been actually some decent support so far. So we'll have to see if we get a breakdown below those levels, but still thinking that we likely do. And if we do see that break below the 76.55, we'll be looking for that 200-week moving average as some likely support. And if we do see a breakdown to those levels, that could be a pretty attractive entry point in energy, as I don't think oil is going to really fall apart entirely. Obviously, we'll see some selling pressure as people are starting to price in recession fears and just overall weakness across the global markets. But I do think it'll hold up at some point, and that 200-week moving average seems like a pretty logical place for it to do so. And if we do see some price action bounce to the upside on that, then I'll likely be getting long energy again. But for now, I'm either short or sitting on the sidelines on the energy space at the moment. And then taking a look at our commodity chart, looks like we got an opportunity potentially to set up a nice short in commodities, but now is not quite the time. We are sitting right above some support at 267. I want to see some price action drop below that and close below that, and if we do see some price action below that 267 level on the CRB index, that could set up a really nice shorting opportunity. We'll be looking at a drawdown all the way down to about that 243 level, and so that would represent about 9% decline in the CRB index. And so that looks like a decent little shorting opportunity once we get below the 267 level on the CRB index. And then taking a look at our consumer discretionary versus consumer staples. Consumer discretionary is a risk-on sector, whereas consumer staples are more defensive. So when we see this chart going down, that's typically a warning sign, and obviously we can see there's been a massive move to more defensive sectors. We did start to see consumer discretionary have a nice little move off those June lows. That's been fairly short-lived, and now it looks like we're heading lower, and people are getting more on the defensive side of things with sectors like consumer staples, utilities, etc. And then taking a look at our global index. So this is the VEU chart. This is the global markets minus the United States. Things are not looking any better over there. We're seeing some pretty big downside pressure on global markets as well. We are at some support at the $44 level on the VEU. So it is holding that currently, but very likely to see some breakdown below those levels. And once we do, we could see a pretty big drop from there, and looking for our next support level just below $38 on the VEU. And then we take a look at our high yield corporate bond ETF. Things are definitely looking very bearish here as well. Our high yield corporate bond chart is at levels that we've only seen the last two times. It was during the COVID crash, as well as during the great financial crisis, where we had a 57% drawdown in the markets. So these are pretty ominous warnings on this chart. I don't think high yield corporate bonds can be this low in a strong market economy, and so this is just another one of many bearish charts telling us, I think, to be cautious and defensive, and really even saying it's probably a really good time to look for the short side of things instead of long. And then jumping over to our precious metals, we got gold. Actually had a decent move to the upside this week. Got back up above where it had actually opened the previous week after a bit of a sell-off. It's not super surprising on that, as we did see interest rates pull back a little bit, and gold oftentimes has an inverse relationship to the 10-year interest rates, and but it's unclear whether or not we've peaked out on those rates yet or not, and we'll get to those charts just shortly. But still looking for probably not any price or any trades here on gold and silver quite yet. But things, I think, at some point are going to get pretty attractive in these sectors. We're just not seeing it quite yet. We'd want to at least get above that 200-week moving average, which would put the GLD up above about 158 until we get above those levels. Not really looking for any trades to the upside on gold right now. And then jumping over to our silver chart, also sitting below some support and resistance right around the 1775 level. Closed the week out at 1750. So we definitely want to see some price action get back above those levels, but also see it get above that 200-week moving average. And if we do get above that 200-week moving average, which is currently sitting just above $19 an ounce, then that could set us up for a long trade on silver, but we're definitely not there yet. Taking a look at our interest rates, our 2-year had a big spike on the, or decent spike on the week, a huge spike the previous week, sitting at about just below 4.3% on our 2-year. Our 10-year closed the week out at 3.833%. We did get to the 4% level and slightly above. It looks like our peak on the week was about 4.04% or so, and but we did see a bit of a drawdown, and that's not surprising. 4%, I think, was a very logical area to look for some resistance, and some people think it could even be potentially the top in the 10-year. I still think with what's going on with the Fed, we could potentially see a little bit more movement to the upside, but it does, whether or not we get above that or not, this is definitely a logical place for it to take a pause and potentially have a pullback for a bit, but I'm still not really looking for any long bond opportunities right now. And then take a look at our 30-year interest rate. Looks like we closed the week out at just below 3.8%. Also got pretty close to 4. We didn't quite get there. Looks like we got up to about 3.925. We'll see if we can get up to the 4% level on the 30-year, but for now we're sitting just below 3.8%. And then taking a look at our yield curve chart. We are sitting at extremely negative readings. We talked about it in a couple of short videos, as well as some of these weekly recaps over the last few weeks, how we've been in some really negative extreme readings. We actually, a week ago, recorded the worst close on this chart that we've seen going all the way back into the 80s or so. So we were sitting well below a negative 0.5% reading. So definitely a bearish signal here, warning of recession as well. And then taking a look at our VIX chart, we did get briefly on Friday, dip below the 30 level. Had we closed below that 30 level, that might have been a bit of a signal to potentially indicate maybe a little bit of a bounce or a calming in the markets, but we definitely didn't get that. We ultimately closed the week out at 31.5 or so on the VIX. A lot of volatility in the markets. We're seeing multiple days where we're sitting above that 30 mark, and we could potentially be heading higher from there on the VIX. So still a lot of volatility in the markets. Almost all these charts we've been going through are pretty bearish. So a lot of these charts are definitely telling us to be cautious in those markets, have good tight stop losses, and if you're a short-term trader, if you're a long-term trader, having some protection in the markets is a pretty good idea right now. And as we can take a look at our put-call ratio chart here, we can see that people are buying a lot of protection. Anything above the 1 mark is some elevated put buying protection, and we have seen a lot of days where we've been well above that 1 reading. We've had a week or two ago, we had a reading well above 1.5. And so a lot of record historic type put buying protection in the markets, both institutional and retail. I think we're starting to get pretty defensive. And when the institutions start buying record amounts of put buying protection, I think that's something to take notice of. And then we'll finish it up with a dollar chart, the DXY. We've been talking about this as one of the most important charts in the market, as it really has a strong correlation, inverse correlation to the markets, and especially crypto. And as we've seen the dollar continue to rise aggressively, we've seen that put a lot of downward pressure on the markets as well as the cryptocurrencies. We talked about how we expected a brief correction as we peaked out right around that 115 level, and we got that correction. It's unclear whether the correction's over or not yet. It is possible this could be the bottom of the correction, which ultimately that is, and then ultimately settled out right around 111.65, 111.70 or so. Either way, though, we could potentially see a little bit further downside pressure. I wouldn't expect too much of a decline below that 110 level or so. But once we do finish this correction off, we're still looking for some upside momentum in the dollar. And our next price target on that one's looking like about 117.75. Thanks for tuning in this week. Make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto. And give the video a like and a share, and we'll see you next time.